Behavioral finance is a field of study that combines principles of psychology with finance to understand how cognitive biases and emotional factors influence investment decision-making. It challenges the traditional financial theory's assumption that investors are perfectly rational and always act in their best financial interest. Here are some key aspects of behavioral finance and its impact on investment decisions. Psychological biases. Behavioral finance identifies various cognitive biases that can affect investment choices. These include overconfidence. Investors may overestimate their ability to predict market movements, leading to excessive trading and overexposure to risky assets. Loss aversion. People tend to feel the pain of losses more intensely than the pleasure of equivalent gains, leading to risk-averse behavior and potentially missed investment opportunities. Anchoring. Investors often rely on past prices or reference points when making decisions, even if those references are no longer relevant. Herd mentality. Investors sometimes follow the crowd, even if it contradicts their own analysis, leading to market bubbles and crashes. Emotional factors. Behavioral finance recognizes that emotions like fear and greed can significantly impact investment choices. For example, fear of missing out. FOMO investors might buy into assets because of the fear of missing out on potential gains, regardless of their intrinsic value. Panic selling. During market downturns, investors may engage in panic selling, exacerbating market declines. Over-optimism. Investors can become overly optimistic during bull markets, leading to overvaluation of assets. Limited rationality. Behavioral finance acknowledges that individuals have limited cognitive resources and time to make decisions. This can result in suboptimal choices, as people rely on heuristics or shortcuts rather than conducting thorough analysis. Prospect theory. Developed by Daniel Kahneman and Amos Tversky, prospect theory suggests that people evaluate potential gains and losses relative to a reference point, usually the status quo, and make decisions based on perceived gains and losses, rather than final wealth. Biased information processing. Investors may selectively process information that confirms their existing beliefs, a phenomenon known as confirmation bias. This can lead to a lack of objectivity in decision-making. Behavioral finance strategies. Recognizing these behavioral biases, some investment strategies seek to exploit or mitigate them. For example, value investing, buying undervalued assets based on fundamentals, exploiting market overreactions. Contrarian investing, going against market sentiment by buying when others are selling and vice versa. Dollar cost averaging, investing a fixed amount at regular intervals, reducing the impact of emotional decisions. Behavioral finance and financial advisors. Financial advisors often use behavioral finance principles to help clients avoid common cognitive biases and make more rational investment decisions. In summary, behavioral finance highlights that investors are not always rational, and their decisions are often influenced by psychological biases and emotions. Understanding these behavioral factors can help investors make more informed choices and build portfolios that align better with their long-term financial goals.